Recipes for technical trading success in Cook's Kitchen.
What was the scariest thing about October? If you were a bear, it was that monster gap on October 23rd after Google, Microsoft, and Amazon reported blowout numbers and their stocks were all up 10% the next day. Let's take a look at that chart. Here's the Nasdaq 100, and as you can see, here is October 22nd, pushing to new correction relief rally highs at 4,500 on the Nasdaq 100. And that afternoon, Google, Microsoft, and Amazon all report very strong numbers. Anybody who was short got toasted because all those stocks went 10% higher after hours on October 22nd. And October 23rd, the Nasdaq 100 opens 100 points higher. And it's been another 100 points higher since then, up above 4,700, making new bull market highs, the Nasdaq. And, you know, if you're a bear, you're thinking, boy, I really got to short this, right? Because this has got to go down and fill that gap. And that's actually the camp I've been in, but I'm thinking about changing my tune. Let's go to my video from last week, my slide from last week, where I gave you my 6 top reasons that the market would not make new highs in the fourth quarter. Here they were. Now, this is a lot of stuff I was talking about before the FOMC. The too scared to hike FOMC did not hike. I thought the decision was priced in. So these are all the things I was talking about, my 6 top reasons to be bearish in Q4. I'm going to reevaluate them now because next week I might be making a video where I give you 3 or 4 reasons to be bullish. So let's go through each one of these. First, the Fed. The Fed did not hike, but what do we have on the table here? We still have a Fed that is too scared to hike and not willing to risk slowing down this economy or shocking money markets. Whether, you know, it's 50-50 if we get that D's hike, but what the market knows is that the Fed is still going to be low and slow. That was the mantra 6 months ago as they jawboned how this policy of liftoff would evolve. You know, the one and done was another cute phrase that's been tossed around. Hey, they do a December. Even if they do December and that shocks markets a little bit, then we know they're going to lay off for 2 months. And the consensus really is that a year from now, Fed funds might be at 1%. Is that accommodative for markets and an economy? You know, the muddle-through economy just growing at barely 2%? It absolutely is. So the Fed is still a tailwind. I've always believed that. I just thought that the no-hike decision was priced in and we go lower. So big, bullish tailwind. You have to make that your number one thing right now to think about if you're a bear or a bull, is that the Fed will still keep the economy humming and be willing to inflate asset prices with extremely low interest rates. All right, what's next? The earnings recession. Hey, the market's telling you it's not so bad. I'll come back to that in a moment. The U.S. dollar and the ECB. Now, this is one that I won't give up on because I think everything's in place for the dollar to get stronger, especially with a U.S. Fed hike around the corner and the ECB ready to fire their next QE weapon. Number 4, here's one I'm going to backtrack on. I've been calling next year's estimate $1.20, but that is not really the consensus. That's just Goldman Sachs' number, okay? I was a little aggressive in agreeing with Goldman Sachs on that aggregate EPS number for the S&P of $120 for next year. Hey, Goldman is glum. David Kostin is glum on this market. He was right all last year, as I've said. He could be right in 2016. But right now, the consensus is actually over $125 for 2016, and that's what money managers are pricing in. So at S&P 2100, hey, we're a little over 16.5 times if you use an estimate of, $126. Okay, so that's the one that I'm willing to give some ground on here as a bear and not dig my heels in. All right, next, the oil patch could get uglier? Yeah, maybe it could. Maybe Goldman's right there too, but things seem to be stabilizing. We'll see how the economy absorbs lower oil and more bankruptcies in the shale patch. The economy has little upside risk. Well, okay, so that's my belief that momentum has been slowing so much, we're going to get to that point where it gets tricky for the economy to stay above 1% growth. But then again, what's the huge tailwind? It's the Fed and extremely low interest rates, and the ECB about to fire another QE weapon. So, there's no guarantee that that things tip recessionary. In fact, the odds are that we could keep muddling along at 2%. So I say there's little upside risk because the 3% growth that everybody predicted for this year, or a lot of smart economists did, that's probably not going to happen. But even if we stay above 1.5% and get up to 2.5%, there's some upside. All right. So what about the earnings recession? Okay. What is the market telling us? My theory has been that with this rally that I wanted to sell is that, hey, it's just a flight to big caps. It was the first energy got us started off the W bottom, and then everybody piles into large cap tech, which was clearly the smart play, and that made the rally unsustainable. But the breadth is coming back. You're seeing a lot of other issues, whether it's mid caps, small caps, other sectors, industrials coming back. So that's telling you that obviously the Q4 chase is on, and the Q4 chase is underexposed money managers who need to get back, put their cash to work, or they're going to look like jerks and possibly lose their jobs or at least their bonuses if they're not long stocks into some kind of holiday rally, right? All right, well, that's in full force. Strong possibility it might stay, and this gap does not get filled, and we just keep going. Maybe this gap gets filled in February or something, but right now, the market is telling us that, sentiment has shifted and money is going to get put to work in the stock market with the Fed tailwind, an earnings recession that is basically priced in and known, and looking ahead to, say, the second half of 2016, where momentum picks up again. All right, so here's Kevin Cook, your resident bear at Zacks this autumn, who is about to turn neutral, if not bullish. And I'll talk to you next week with that update.